I got friends only wanna talk business. I got expensive, cause winning's expensive. I got expensive, cause winning's expensive. I've been reading all the war, and I've been shutting down the stars.
And welcome to Put That Coffee Down, the Freight Sells, a show for closers here on FreightWaves TV, 12 p.m. Eastern Time on Tuesday. My name's Kevin Hill. I'm your host, as always. And today we're going to talk about financials and sells and how you can use the company's financials, especially if they're a public company and they're readily available, to your advantage in your research, your pre-call research. And we'll have on Seth Holm. He's the founder of Westbrow Capital Management here in a few moments to talk about earnings season. And we'll talk a little bit about financial research. But it's an easy thing to do. I don't think a lot of salespeople do this, is to peek inside that 10K or that 10Q or that investor deck. All you have to do is search the company name, investor relations. That will get you to that page. All public companies have to have that section on their website. And from there, you can look at recent news, 10Ks, right? That's the annual report, right? And it's a pretty daunting report. It's usually 150, 200 pages. It seems insurmountable, but Control Find is your friend on those. You can go in and look at risk factors. You can skip all the tables and numbers if you want, because there's a lot of juicy information usually embedded in the writing. A lot of that's boilerplate writing. Just hit Control F on things that you want to look for, and usually you can get a really good sense and perspective of what a company is doing. And I was researching around Autobound.ai. It's a sales research group. It has some really good tips here about what you can find, and this is what I do in a lot of pre-call research as well. Some things you can find in the 10K is new product development or expansion into new markets. So what is that? This new corporate strategies. It is strategies of expansion, new business, right? New distribution, new transportation, things that we're currently working on, as well as shrinking, right? Or the discontinuing products. These are really good questions to know when you're talking to people involved in the supply chain at shippers. Really knowing that, kind of knowing what the strategy is, what they're communicating to the market, to their investors, to those Wall Street analysts is key to knowing this. Negative industry trends or competition. This is where really supply chain issues come into effect. What are competitors doing? How are they positioning themselves against competitors? All things that you can put into your pitch deck whenever you're talking, into your conversation. People like to talk about the business that they're in, not necessarily transportation, but the business they're in. If you can gain a lot of credibility talking about what they do on a day-to-day basis, what the company does on a day-to-day basis, then you can blend transportation into that momentarily. So also increasing expenses or operating costs. This is not really CapEx, but CapEx goes into that. That's a really good metric to know is, are they increasing their CapEx spending? Are they decreasing that? Where are their capital investments going into? And also, what are the new capital? What are the new initiatives, right? Kind of falls back into that new markets, new products kind of space there. So, but where are they trying to cut their costs? Where are they working on to build a more efficient operational structure, maybe a more efficient sales channel and distribution structure? So those are always really good indicators of where a company is going, what talking points that they really want to hammer down, what they're focused in on. And then, of course, acquisitions, new companies being acquired, or divestitures, right? If they're divesting of companies, of non-core assets, that's really good to know. Because it's going to shake out their supply chain. It's going to shake out their supply chain and their distribution. So those are some good tips. If you want to learn more about using 10Ks, just hit me up on LinkedIn. Always glad to talk about that. Maybe something that I'll write about here at a future date, or maybe go into more in depth in videos. But it's really important to do your pre-call research. If it's a public company, it's really easy to do. It's so easy to do. I have an expert on here right now. He is a former FreightWaves. We worked together here for a number of years. He came from the hedge fund industry and went back, founding his own hedge fund that is focused on transportation and logistics equities. It's Mr. Seth Holmes right here.
Hey, Kevin. Thanks for having me on.
Anytime. It's always a pleasure to talk to you, especially when we're talking about stocks and equities and financials. And my first question for you is going to be, what's your favorite metric or your favorite item whenever you open up a 10K or if you start looking at a company? What do you want to know first?
Well, if it's a transportation company, operating ratio is always up there. OR, revenue, certainly important. If you don't have revenue, you got to keep the business growing, and you look at who's less cyclical. This is an interesting time in transportation. UPS just reported. I just got off the call as I got onto this one, and it's down almost 10% today. So I think it varies by company. Usually, whether I'm long or short a stock, I have a couple bullet points that I care about to my thesis, and usually that's something I'm looking for. So definitely revenue, operating ratio, and then what people in Wall Street call KPIs, key performance indicators. So a good example of that might be for a trucking company, revenue per truck per week, what spot rates are doing, contract rates, that sort of thing. Fundamental drivers of the business. Those are the types of things I'm looking for.
And so let's talk about your hedge fund, Westbrow Capital Management, and kind of you mentioned long short, kind of what your investment strategy is and what you do.
Yeah, sure. I founded Westbrow Capital about a year and a half ago. To my knowledge, we're the only long short transportation fund in the marketplace. We invest globally. The only other thing I would say is we do all of the stuff that probably your audience is very focused on. So we do a lot of investing in freight transportation, so trucking, railroads, LTL, all that sort of stuff. But we also do a lot of other stuff in autos and airlines and electric vehicles and things like that. We are based here in Chattanooga. Took a lot of what I learned at FreightWaves and from you and some of other friends and formed this fund. And we're off to a good start. It's not the easiest time to be a transportation investor. I think JB Hunt mentioned we're on in the middle of a freight recession right now, and maybe an overall economic recession as well. But we're hanging in there and off to a good start this year.
Yeah, let's start with JB Hunt, right? They're usually the bellwether, the first to report in the space each quarter. And, we saw what the market's been telling us for the last year. It's catching up, and we are in a freight recession. We seem to still be in the freight recession, I guess, is the best way to put it. And, we have a few companies out so far reporting earnings, and it's about what we expected. That 40% rise in revenue, especially for the brokerage houses that we saw during the pandemic, 2021. Those have receded down to losses now.
Yeah, I mean, with JB Hunt, I think JB Hunt's interesting. It's large, right? It's got a big market cap. It's
diversified.
Very high quality. It's diversified. So that's the other thing I was going to say. It gives you a great read on when they report early. It gives you a read through to everybody else's business. So about half of the business is intermodal, but then you've got dedicated trucking in there. You've got ICS, which is brokerage, and then final mile and some other things in there. And so overall tone was weak. To state the obvious, the stock hung in there, which I found interesting. I think it's giving back a little bit here now, but so expectations are low. I think everyone kind of knows we're in a freight recession. Anyone that looks at the data like us, especially on the trucking side, can sort of that's not too difficult to tell. But not a great start for the transportation industry in general. And then we followed that on with UPS today. So more weakness, and it seems like low expectations were well deserved, at least so far. And Knight, I didn't mention Knight. Knight guided down.
Yes.
They had been sticking to this $4 trough earnings number, and they guided that down all the way to $3.35. And so there was an insurance piece in there. But when you look at it, I'm sure we'll get into it later. I mean, spot rates are undeniably, so low that it's hard to to say they get much worse, but it's a big different story on the contract side.
It is. I mean, but do you think that most logistics companies, take Knight-Swift, JB Hunt, that they're not down that much because this is already baked into the stock price, weak earnings?
I think that's part of it, and I think this was sort of dispelled. There's been this narrative at all the conferences I go to and listen to, sort of promoted by public transportation executives, that there was going to be the back half hockey stick, and the overall market believes this as well. And it was basically premised on, retailers have been drawing down their inventories and they're going to build them back in the second half. The only problem with that, and I think Craig touched on this in his State of Freight, was there's actually no data or evidence to suggest anything about a second half snapback. And I think JB Hunt spoke to that, where they said, well, our retailer kind of shipper customers, we're expressing optimism, but we're kind of losing a little bit of confidence in that ourselves. So I think people are, it's a bet both on transports being early cycle. So maybe they've already gone through their, they led and went through their rough patch first. Maybe some people bottom fishing, saying the numbers or the guidance isn't going to get a lot worse from here. And then maybe a little bit of the overall market seems to believe that we're going to have a soft or no landing, which I personally don't agree with. But I think that's also probably helping prop the stocks up a little bit as well.
So when they say soft or no landing, and you don't agree with that, do you agree that you don't see a recession, or you don't see a soft landing of a recession?
Well, I'm a market person and a stock person. I just look at what the stock market is saying, and multiples have barely come off of the highs from 2021 when we're at around 19 times earnings on the S&P 500. And you look up and down the transportation space on the freight side, and these multiples, what makes it difficult for me as an investor, the results are undeniably poor and getting worse in most cases, but the multiples are high. Right. So generally, you want to buy transports when things are ugly. Then you don't think they're going to get that much more ugly. But usually that comes with a better multiple. The trucking multiples are kind of interesting. They're kind of, really on the lower side. They're the only ones out there. And they, as well, they probably should be, because contract rates, the gap between contract rates and spot rates is, I don't know, as wide as the data's ever been since FreightWaves is tracking it. So if spot rates don't stabilize and or come up to meet contract, you have a problem on your hands.
Yeah, I think what you're seeing, and it's been very slower than I ever expected, is contract rates are coming down, and they're going to continue to come down and eke down, just barely, it seems like, because that spread has been wide, and it's been wide for a really long time, much longer than I ever thought it would. I remember the paper that you wrote when we were at FreightWaves, about, because I always get calls and people saying, like Knight-Swift, JB Hunt, they're kind of insulated, especially on the stock side, because, 95% of their business is contract, right? And contract is still really healthy. But as we know, that the market trades trucking companies based on spot prices and not contract market. Whatever the spot market's doing, it's almost identical 1-to-1 correlation to what the stock price is doing.
That's right. And so I would say, look, I'm optimistic on trucking, particularly in 2024 on the spot rate side. And you guys at FreightWaves are much closer to the data. I, of course, track it. But I think we're somewhere around $1.50 on the spot rate side, which, you've had something like 30 or 40% cost inflation. So you're back kind of at those 2019 lows on the spot rates, on the national kind of line haul index and FreightWaves. But in the meantime, costs have gone up by 30%. So that's clearly not sustainable. And so I agree that spot rates, there's not a real good argument in my mind to what's going to make them V-shaped rebound or take off to the upside. But I do think that they're, in the process of bottoming, and therefore truckload stocks look pretty good, probably heading into 2024. But it's also, it's also hard to argue that the economy, this is all happening at the same time that, for example, consumer spending just turned negative for the first time in a couple of years on the Bank of America and the Barclays and the Citi credit card data we look at. So good spending. I mean, I just heard it on the UPS call, the exit rate. So when you ask things I look at, listening to the UPS call, Carol Tomei spoke to parcel volumes. January was above plan, February was in line, and March was horrible. And so that's not a good sort of sequence for the industry. So I think trucking is in the process of bottoming. The main issue is, per that FMCSA data, capacity is up something like 30% over the last 2 or 3 years. And spot rates are, on an inflation-adjusted basis, are nearing all-time lows, at least in the FreightWaves data set that goes back to, 2017 or something.
Yeah, they definitely are. And again, I don't see any data. I don't see any chatter or really any sentiment for that hockey stick or the optimistic back half of 2023. I just haven't seen anything that would indicate that anything's going to change, whether, and it's an effect, right? It's a derivative. Trucking is a derivative of really the consumer and business health. And I don't see any sparks of life. I was talking to Anthony Smith earlier this morning, and he's baking in, he's not saying that there's going to be a recession in the back half of 2023, but he's worried about it. And I guess it just goes back to, I don't see any optimistic outlook that the spot market's going to take off, that the contract rates are going to stay steady or inflect upwards as well. I think it's going to be a slow grind. And we saw that in 2019 too, right? 2019 going into 2020, there was just no data points showing that the market was going to turn at all. We got a huge surprise with the pandemic, which turned to all which ways but loose, right? But that is something that no one could have predicted.
Yeah, so I think my overall view from an investment perspective on trucking is it's in the process of bottoming, but that doesn't mean run out and buy trucking stocks. I mean, 2024, I think, might be better and might have good returns as the expectations that we talked about in the back half kind of get toned down a little bit. Whereas, on at least on a relative performance basis, I do think trucking will do better than the overall market going forward. If what I think comes to pass. I mean, the Fed on May 8th, I believe it is going to get, Fed funds rate up to 5%. So they've hiked 5% in 12 months, which is the fastest they've ever done it. And there's long and variable lags to interest rate policy. And I think that's just starting to show up in the data.
Yeah, it would go off trucking, go to LTL or freight brokerage. Talk about preview for C.H. Robinson and kind of others, and just see the health of the market there. What are you thinking?
Yeah, LTL's probably the best, just because it's not highly fragmented like trucking. So even in a year like this, it might be a down earnings year or a slight down earnings year. But most of the trucking companies are talking about a 30 to 45% kind of drawdown in earnings compared to kind of 21, 22. LTL should be able to keep their earnings relatively flat and intact in 2023. And that's just because of those general rate increases they're passing through. So most of them are passing through, mid to high single digit price increases. And so they've been able to offset that volume compression. They've seen as low as, I think back in December, LTL tonnage was running as down double digits at one point, but they've been able to offset it through good cost control and passing through price increases. Brokers, I think brokers are a tough spot. Just secularly, the growth story has been kind of, I don't want to call it over, but it's been challenged for years. And then from a cycle standpoint, spot rates continuing to go down is good counter-cyclically for their margins, but it's also really bad for their load volumes, and it's going to bring their contract rates down with their shipper customers. So LTL I'm probably most favorable on. Freight brokerage is just kind of a neutral for me. I'm not involved. C.H. Robinson's a little bit interesting. they've got some executive changes going on there that make it more of a sort of an idiosyncratic story relative to the rest of the brokerage industry. There's been speculation that they're going to hire a former UPS executive, and that's kind of made the stock perform, I think, better than it otherwise would have based on its fundamental results.
What do you think? Do you think Old Dominion dominates earnings this quarter? You still a bull on Old Dominion?
Well, they're losing their people to XPO. XPO was up 30, 40, 50% in the last week on hiring a new COO from Old Dominion. Old Dominion's going to always do well. I don't think they're going to do well by their own standards for the next kind of couple quarters. Even when you're the best, I think they're going to go through a soft patch here. Saia is interesting to me on the LTL side. They're kind of they've got some stuff going on. They're growing their terminal count a lot, and they're really they have a price gap relative to the competition. If you look at how they charge, and so that Saia is interesting to me. And then of course TFII is kind of a different animal, but I've always liked that one. I think if the market continues to get worse, you might look for TFII to make some accretive acquisitions at the bottom of the market. It probably won't be ArcBest, but a company like that, they've got some self-help initiatives going on with that UPS freight acquisition from a couple years ago. They're still bringing the OR. The OR got down from about 100 down to about 90, but that's still, way off the best in the industry, the Old Dominions and the Saias of the world. So LTL is probably my most favorable area. And of course, we didn't talk about rails, but happy to do that as well. But intermodal, also very weak. Intermodal is tied to consumer spending, as you know, and with spot rates at $1.30, that's not good for the intermodal business because the shipper can, use a truck, which is faster and, and for as cheap as they could ever get it in the spot market. So.
Yeah, I mean, if we take a look at rails and then ocean as well, just very weak markets in both of those. I think the party's over on that aspect of $15,000, $20,000 containers. Yeah,
they've come up a little bit off the bottom, which I think mainly due to blank sailings and the fact that there's a coalition there's a lot of concentrated market share there, and they've come up from something like $1,000 per FEU to on that West Shanghai to Los Angeles route to like 1,700, and I don't think that's going to last. Or I wouldn't expect them, as Craig says, I wouldn't expect to see $20,000 rates again in his lifetime, I believe was his quote. And so I wouldn't. But there are pockets of ocean shipping. This is probably not something that your audience pays a great deal of attention to. Without a doubt, containers are extraordinarily weak, and I think they'll get weaker given the outlook for the economy and consumer spending. There are pockets of strength in shipping that we're invested in, things like crude tankers, product tankers, and LNG, which I know your shipping site writes about a good bit.
Yeah.
So
what do you think about? Oh, go ahead. What do you think about M&A and M&A activity in the back half of 2023? You think we're going to see it in trucking and brokerage? Some consolidation happening, or smaller plays?
Yeah, I think it makes sense. I mean, we obviously saw Knight-Swift and U.S. Express, and I think it doesn't make a whole lot of sense to be a small cap publicly traded trucking company because you generally don't get rewarded with a premium valuation in an up market, and your stock doesn't arguably go up as much as it should, and it gets all of the downside and then some in bear markets. And so I do think that rates being where they are and trucking in particular being a capital intensive business, it's probably not the best time. You need to get a good multiple on those deals, right? Because your cost of capital has gone way up over the past year. But I think for large enterprise trucking fleets that are looking to pick off assets on the cheap with good balance sheets that are underlevered, like Knight Swift, the Schneiders of the world, I do think that they'll continue to make more deals. And, one thing that I thought was interesting, you and I used to debate whether there were economies of scale in trucking. I just found it interesting, just from an observatory perspective, seeing that these executives seem to be making the bet that there are. And so I do think we'll see more M&A. The market likes it. The market seems to like it. And yeah.
We definitely will see. That cuts it for our time today. We'll come back and talk more M&A and economies of scale because it is very interesting. But thanks, Seth, for coming on today.
Of course. Thanks for having me.
And that wraps it for this episode of Put That Coffee Down.
I got friends only wanna talk business. I got expensive, cause winning's expensive. I got expensive, cause winning's expensive. I've been reading all the war, and I've been shutting down the stars.